Now let's assume that you and some other friend of yours or some other individuals registered a business to be managed by you and those individuals or those your friends. That type of arrangement is what we call partnership, because you and these your friends or these other individuals have agreed to manage or co-own the registered business with the motive of making profit. Now, have you understood that? We'll be taking this explanation further by looking into accounting for partnership business or partnership accounts. A partnership business is a business jointly registered and owned by two or more parties or individuals who have agreed to manage the business according to stated agreements with the aim of making profit. Now, the idea is that two or more people are coming together to carry out or manage business activities, and this business must be registered to be carried out, in a going concern manner. But the idea is that there must be the aim of making profit. The essence basically for partnership is to put resources together to achieve stated goals. What I'm saying is you have individuals with different background, different connection, different contacts, different resources. So it is always very essential to bring this pool of resources together through partnership to achieve stated goals and objectives. Now, elements of partnership. For a business to be called partnership, it must possess the following fundamental conditions. So what I'm trying to say is, for you to say a business is partnership, it must have the following elements. One, it must involve the minimum of two individuals who have agreed to jointly own and manage the business. So we have 2 to 20 individuals coming together to form a particular business. And then there must be profit-making motive that will be divided, by the owners based on agreed terms. And then there must be cooperation and trust. These three is what we call the elements of partnership. Partnership deed or article of partnership or partnership agreement is simply the documentation or the document stating the agreement guiding the conduct of the partnership business. What we're saying is, for a partnership business to be conducted, there's a need to have laid down rules, laid down agreements. The document that has it is what we call the partnership deed. Now, this is formal partnership agreement. It's very simple, where you have the individuals involved or the partners involved agreeing to a written document prepared by a lawyer or a solicitor to be signed by all the partners. We refer to that agreement as formal. Informal partnership agreement. In this case, there is no written agreement. So there are other forms. There was an application of other ways of having an agreement. It could be a gentleman agreement, or exchange of letters or memos or behavior of those involved in the partnership. So the idea is that there is no written document that is signed by the partners, but they have utilized other informal ways of reaching the agreement to guide the partnership business. Now, we already defined partnership deed as a document that contains the guiding rules, of conducting the partnership business. Now, what are the contents? Before even looking at this, we can just, look at it from the angle that, okay, you are going into a business with someone. What are the likely things that you're going to be agreeing on? You're going to be agreeing on capital to be contributed. You're going to be agreeing on how to share your profit. You're going to be agreeing on any interest to be paid on the capital you're contributing. You're going to be agreeing on any interest to be paid on the loan you give to the business. You're going to be agreeing on salaries to be paid. You're going to be agreeing on interest to be paid on drawings made out of the business. You're going to be agreeing on how to bring in new partners if you have to. You're going to be agreeing on any other allowances that should be paid to partners. You have various other contents, okay, that have to be the procedures of sorting out conflicts among partners, procedures of retirement if a partner has to retire. So these are basically the contents of the partnership deed. Now, it is possible that a partnership is entered into, by individuals without having a partnership agreement. So we refer to that as what? Absence of partnership. Now, where there is absence of partnership, okay, it is possible to have issues, and these issues will be resolved by the partners. But where there's an issue that cannot be resolved by the partners due to absence of agreement, then we'll be referring to the provisions of the Partnership Act 1890. Now, because there's no agreement among the partners, and now there's a conflict, okay? So we apply the provisions of the Partnership Act 1890. What are the provisions? Profit and losses should be shared equally. No interest to be paid on capital. No interest to be charged on drawings. Capital contribution should be equally. No salaries or allowances should be paid to any partner. Admission and retirement of partners should be with agreement by all partners. Any loan advance to the business by partners attract 5% interest. So where there's no agreement or there's a conflict resolving, issues because there's no agreement or because of absence of agreement, we normally will apply the provisions of the Partnership Act 1890. Now, as a partnership business, we can classify it into two types: general partnership or limited partnership. Now, general partnership is a type of partnership in which all the partners involved are liable for any partnership debt that arise. If there are 20 in number or if there are 10 in number, all of them are responsible for any partnership liability or partnership debt or partnership obligation where the need arises. If the partnership business runs into a debt of 1 billion naira, everybody is involved. Everybody is responsible. That's why it's called general partnership. We're talking about the business now, not the partners. The business, how it is structured, So you can have general partnership where all the partners involved are liable to any partnership debt. Now we have limited partnership. The limited partnership is structured so that among the partners, there are selected few that are liable to the partnership debt, and then there are selected few that cannot lose more than the capital they contributed. So what I'm saying is, if for instance you have 20 partners or you have 10 partners, for instance, out of the 10 partners, maybe 3 or 4, okay, cannot lose more than the capital they have contributed where there is any partnership debt or liability. But the other ones will now be liable for the partnership debt. Now that type of arrangement of partnership, what we call limited partnership. This now, types of partners. So the partnership business has various partners. So these partners are in various types. The first one is general or ordinary partner. Now, if a partner is referred to as general or ordinary, it means that the partner does not have a limited liability. That is, the partner's liability is unlimited in case of partnership debt, regardless of capital contributed. Even if you have contributed 10 billion, when there's a partnership debt, you are also responsible. That's why they call you general or ordinary partner. The next one is limited partner. A limited partner cannot lose more than the capital contributed. So if the partner, for instance, contributed 1 million as what? The capital. When there is a huge debt or huge liability, he cannot lose more than the 1 million he has what? Contributed. That's why they call him what? Limited partner. So now we have active partner. An active partner is a partner that what? That is involved in the day-to-day management of the what? Business, despite capital contribution. So usually when you have a partner that is active, you have allowances or salaries paid to him for what is active involvement. So any partner that is actively involved in running the partnership business is referred to as what? As an active partner. Now we have sleeping partner or dormant partner. The partner is said to be dormant, because he is inactive. So where you have a partner that contributed capital but is inactive in what? The day-to-day management of the business, you refer to that partner as what? A sleeping partner or a dormant partner. Now, a nominal partner, also called just for the name partner. The idea is that the partner allowed or agreed that his name should be used as part of, the partners of the business. It could be that the person has connections. It could be that the person has a reputable name. That kind of arrangement, because that person's name can help attract sales or can help do, add value to the business. He allows his name to be used as one of the partners of the business. So we call that person nominal partner. Now there's another nominal partner that just created an impression. He's not a partner, but he created an impression that he is a partner of the business toward an external party. Okay? That sort of impression will make him liable with other partners when there's what? There's a debt to that external party. Let's say, for instance, the partnership business, and one of the partners, and while you are with the partners, maybe at a discussion with an external party, okay? In the process of discussion, you gave the external party the impression, okay, that you are part of the what? Business, whereas you are not. The implication is that you are liable if that's what impression results into what? A liability for the what? Partnership. You're liable along with other partners to the external party. So let's take some terminologies. We have partners' drawings. That's where partners take part of the goods in the business or take cash out of the business for their personal use. You're in a partnership with your friends, and then in the process, you took out some money for your personal use. We call it partners' drawings. The next one is interest on drawings. Usually when a partner takes out goods or takes out cash from the business, they normally will charge that partner interest, on the drawings. The idea is that if the partner did not take that cash or did not take that goods, it could be sold and profit to be made. So where you take goods or cash for your personal use, you will normally be charged what? Interest. The next one is partners' capital. That is the quantified resources or the value of the cash or properties that each partner contributes. So if, for instance, you're in a partnership with, say, your friends, okay? So what do we say? If you contributed 10 million and a house, or you contributed 10 million and a car, that 10 million is the capital. The car is also a capital. So it depends on what has been contributed, but whenever contribution is made to begin a partnership business, either in cash or in other form of resource that is what? Quantifiable, we call it partners what? Capital. The next one is fixed capital. Fixed capital, from the name, means that the capital does not change. If you're maintaining 1 billion as the capital of each partner, it remains 1 billion throughout what? The years of operating the what? Partnership business. Now, floating capital, you can also say fluctuating capital. Now, what we're trying to say is that the first one we discussed is fixed. It does not change. But in this case, the capital changes as profits are shared, as interest are earned, as salaries are received. Okay, the partner's capital will change. So if you brought in 1 billion and there was a profit of 500 million and it's shared across board, if what you got is 100 million, it means your capital will now increase from 1 billion to 1.1 billion. That I will call it floating capital. The capital changes as what? Profits are made, as interest is earned, as salaries are received. Okay, the next one is partner's current account. Now, where you are operating a fixed capital, okay, any excess that cannot go to the fixed capital account comes to the partner's current account. So what I'm saying is that whenever you're operating a fixed capital account, you must have a current account to take the excesses. Anything that will either increase or decrease the capital goes to the partner's current account because you're operating a fixed capital account. So if you're operating a fluctuating capital account, there's no need for partner's current account. But if you're operating a fixed capital account, there's a need for what? Partner's current account. The next one is interest on capital. So what it means is that the capital that has been contributed to the business should attract interest. So the interest payable on the capital is what we call interest on what? Capital. The next one, partner salaries. That is the agreed sum payable to what? To any partner as a monthly wage or as an allowance, okay, for being active, okay, or to have done any thing that puts him in that capacity. So the idea is that once there's an arrangement to pay an agreed sum as a monthly wage to a partner, we refer to it as partner's salary. Now we have another terminology, interest on partner's loan. So what we're saying here is that the partner gave a loan to the partnership. So the partnership is expected to pay interest on that loan. So when you have interest on partner's loan, it means interest that is paid on the loan given to the business. So if you're in a business with your friends, for instance, okay, that is partnership, and then you already contributed maybe capital of 100 million, and then for some reason you have to now loan the business additional 15 million. That 15 million is the loan as a partner to the business, and that's that loan must attract interest. So we call it interest on partner's loan. Profit. So it means that as the business, okay, is operated, it either makes profit or loss. So when profit is made, it is shared among the partners. So we call it share of what? Profit or what? Loss. So usually you can share profit in any format, maybe equally, maybe capital contributed ratio, or any basis agreed by the partners. But where there is no explicit expression, where there is no rule or no agreement on how the profit should be shared, we apply the Partnership Act 1890 that says that what? Profit should be shared what? Equally. Now we have minimum share guaranteed, or guaranteed minimum share, or guaranteed minimum sum, or minimum sum guaranteed. Now in some partnership business, some partners are guaranteed a minimum amount of the share of profit. What I'm saying is that no matter how small the profit is, okay, the partner is guaranteed a particular sum. He cannot get less than that amount. So you can have a partnership business where you agree that as a partner, you can't get less than 1 million naira. That 1 million naira is called the minimum share guaranteed, or minimum sum guaranteed, or guaranteed minimum sum, or guaranteed minimum what? Share. Now we can now have premium minimum share or premium minimum sum. What we're saying is that, the calculated profit for the period is higher than the minimum sum that has been guaranteed. So if you're guaranteed a minimum of 1 million naira, and then when the company is doing its P&L, the profit shared allotted to you is 1.5 million. Your minimum guarantee is 1 million, but now they are sharing profit and giving you 1.5 million. So in that scenario, we say you have a premium minimum share. And what they do is to what? Pick the higher sum. So if they guarantee you as a partner 1 million, and at the end of the year, they now shared 1.5, they will pay you the 1.5 instead of 1 million. The next one is discounted minimum share. It means that the calculated what profit is less than what? The minimum amount that has been guaranteed. So you're guaranteed 1 million minimum, but when they now calculated the profit, you now find out that what? That the profit allotted to you or shared to you is now 100,000. They cannot pay you 900,000, they will pay you 1 million. But the arrangement has resulted to what? A discounted minimum share, because the profit shared is less than the minimum amount guaranteed. They will now have minimum share at par. It means that, it's quite rare, but you never can tell. So it means that when they calculated your share of profit is equal to the amount that has been guaranteed. So in the case of discounted minimum share and minimum share at par, what happens is that they pay you the minimum share. So it's only when the calculated profit is higher than the minimum share that they pay the higher amount, which is the premium minimum share. But if it is lower than the minimum amount, they pay you the minimum amount. They can't pay you less. If it is at par, they pay you the somewhat guaranteed. Now, accounting for partnership. So it's the same thing that we do. We prepare trading profit and loss accounts, just like we prepared for one-man business. So I've already taught us how to prepare trading profit and loss account. Your trading account is to derive your gross profit or loss. Your profit and loss account is to derive your what? Net profit or what? Loss. I told you your trading profit and loss account, is a function of your turnover, cost of goods sold, other income, and total expense. So turnover minus cost of goods sold gives you your gross profit. Gross profit plus other income gives you your gross income. Gross income minus total expense gives you your what? Net profit or loss. So we've already had a class on how to prepare trading profit and loss account. So you can go back to the trading profit and loss account on our YouTube channel, to familiarize yourself with how to prepare trading profit and loss account. It's the same thing. Now, this is peculiar to partnership. We call it profit and loss appropriation account. What we do here is to show the distribution of the profit or loss made by the partnership business among the partners. So if the business made a profit of 1 million naira, the account in which we share that profit among the partners is called the profit and loss appropriation account. This is how it looks like. This is it. Partner X and what? Y. So we have profit and loss appropriation account. So this is the debit side. Partners X, we're sharing the money. But when we're sharing the money, it's possible that some partners will be owing the business, and it's possible that the business will be owing some partners. So in that sharing, we take recognition of all those items. So here we have partners expense, debit, and then we have what? Partners income. Okay, so this is the net profit brought forward, the one that you got from your trading profit and loss account. Now, it is possible that a partner took part of what? The cash or part of the drawings of the business. And we already explained what drawings mean. So when a partner takes out of the business for its personal use, it's called drawings. And the business will normally charge the partner interest. So the partner is paying the business interest. So that becomes an income. So we add it to what? To the what? Profit made for the year. So we have, for instance, net profit brought forward, which is the profit from the trading profit and loss account. This is it. Then we now have interest on drawings. The partners are paying the business. So X is paying, Y is paying. So if you add these three, 1, 2, 3, you have this. Okay. Now we now have salaries. It's possible that you give some partners salaries. So in this scenario, we're paying Y salaries. You take it out. Interest on capital. The partners brought capital to the business, and the business paid them interest for the capital. So when we calculate it, we have for X, we have for Y. We pay them. So whatever is remaining, we now share it among the partners, X and Y. So at the end of the day, everything is what? Equal. So here we have the partners' capital account. So every partner has, an account for the capital they contributed into the business. Okay? So the same thing, you have your capital. Okay, but in this case, you have it for the partners involved. And because the fixed capital, it does not change. So you have A and B, for instance. So we say partners fixed capital account. So we have balance brought forward. Capitals are credit. Okay? Remember your trial balance. You can go to the class for trial balance and understand the capitals are credit. So balance brought forward is here. So we have A and B. Partner A and B for credit, partner A and B for debit. So balance brought forward, we have A, B. So if A brought in 1 million, put 1 million here. If B brought in 2 million, put 2 million there. It does not change because it's a fixed capital account. So here we have partner's current account. I already explained to you that whenever you're operating a partner's fixed capital account, it does not change. So if it is 1 million, it's 1 million all through the period. But any excess, maybe there's share of profit, there's interest on capital, okay? Any excess that should be given to the partner cannot go to the partner's capital account. We take it to where? The partner's current account. So the current account takes the excesses that cannot go to the capital account, except you're operating a floating or fluctuating capital account. Okay, so if you're operating a fluctuating capital account, all the excesses will go to the capital account. So that means capital changes from time to time. But if you're operating a fixed capital account, capital does not change. It is fixed. Any excess goes to the partner's current account. So let's see. This is it, X and Y. Partner's current account. So we have balance brought forward. Here it is. Okay, so if the partner made some drawings from the business, it will reduce the balance. Okay, you took money from the business for your personal use. We'll take it out. Then the drawings you made, we charge the partnership charged you interest. You pay, take it out of your what? Out of your balance. And then the capital you contributed, the partnership will pay you interest on your capital, so it will increase it. You come to the credit side. It's possible that they pay you salaries. So wherever they pay salaries, it could be X, it could be Y, but this scenario is Y. And then the share of profits between X and what? Y. So at the end, you balance your account. The total here is total in X credits minus total in what? X debit. So you have balance carry down. Total in what? Y credit minus total in what? Y debit. You have balance carry down. So the balance carry down turns to balance brought down under X and what? Y. So basically the current account takes any excess, any addition that should go to the capital account or the partner's account, it goes to where? The current account. So here we have partner's balance sheet. Your balance sheet is normal, just the way we prepare it. I've taught you balance sheet. You can go back to the balance sheet class to understand how we prepare the balance sheet. But there are some peculiarities here. So usually your balance sheet shows your what? Your assets and your liabilities. Assets of the business and the liabilities. Look at it here. Statement of financial position as at 31st December 2018. Okay, so we have the assets, non-current assets. This is the note to show the detail. I've already taught you how to prepare balance sheet. So go to your class for trading, profit and loss account and balance sheet. It's the same way. So this is the non-current asset. They are fixed assets. So the note here shows you the components. If you have land, building, furniture and fitting, blah, blah, the total is showed in note 5. Other assets, the same thing. Goodwill, patent right, and other fictitious assets that might be recognized. So when you add this to this, you have this. You have your current assets, cash, debtors, okay, prepaid expenses and all that. So you have it there. So when you add this, so when you add this to this, you have your total what? Asset. So your long-term liabilities, what are they? Bank overdraft, bank loans, okay, and other long-term what? Obligations. It comes here. Short-term loans, bank overdraft, and other short-term obligations. It comes here. So the only thing that comes in because it's a partnership business is that you must recognize the partner's current what? Account balance. Look at it. And then you have the partner's equity. Put it there. So the partner's current account balance, you have X, you have Y. When you add the two, you have this. The partner's equity, you have X, you have Y. So when you add this to this, you have this. When you add this to this, you have this. So by the time you add your long-term liability with your short-term liability, with your partner's current account, and then with your partner's equity, you have your total liability, which must be equal to your what? Total assets. In this class, we've been able to give an introduction into partnership, from the definition to partnership deed, to content of partnership deed, to scenarios where there's no partnership agreement, absence of partnership agreement, to terminologies. and then to the accounting for partnership, the trading profit and loss account, the fixed capital account, the current account, the balance sheet. Okay, so join me in the next class, for illustration on how to prepare these accounts. Thank you.